You lose a trade, so you open another one. That one loses too. So you open a bigger one. This loop has destroyed more accounts than any market crash in history. It has a name: revenge trading. And almost every trader who has blown an account has done it. Most traders know revenge trading is dangerous. They do it anyway. That is the central puzzle. Knowing something is harmful does not stop you from doing it. Not when the trigger is a financial loss. Here is the pattern at its simplest. A trade fails. The account is down. The rational response is to stop, review, and wait. But the emotional response is different. It says, recover that money now. So the trader opens another position, often larger than the first, often without a clear setup. The goal has shifted. It is no longer about finding a good trade. It is about erasing what just happened. That shift in motivation is where everything falls apart. Data from retail brokerage firms consistently shows that roughly 70% of active retail traders lose money in any given year. Some estimates put that number even higher. Behavioral analysts who have studied losing accounts point to emotional trading as one of the top causes. Not bad strategy, not bad market conditions. Emotion. Revenge trading sits at the top of that list. To understand why revenge trading happens, you need to understand loss aversion. In the 1970s, psychologists Daniel Kahneman and Amos Tversky conducted a series of experiments on financial decision-making. What they found changed the field of economics. Humans do not evaluate outcomes based on logic alone. We evaluate outcomes relative to a reference point. And losses feel roughly twice as painful as equivalent gains feel rewarding. This is called prospect theory. It earned the Nobel Prize in Economics in 2022. A simple version. Imagine you gain $100 today. Tomorrow you lose $100. Mathematically, you are back to zero. Emotionally, you are not. The loss carries more psychological weight than the gain. That imbalance pushes people to take risks they would not otherwise accept. For traders, the consequence is direct. After a loss, the brain does not say, stay objective. The brain says, fix this. Here is what is happening biologically. When you lose money, the body's stress response activates. Cortisol levels rise. The prefrontal cortex, which handles rational analysis and long-term planning, becomes less active. The amygdala, which handles threat detection and reactive behavior, takes over. This is the same mechanism that prepares the body for physical danger. It is useful in emergencies. In financial markets, it is destructive. Researchers at the University of Cambridge studied this in live trading environments. They found that traders under stress made increasingly poor decisions over time. The critical word is over time. Stress does not only affect one decision, it compounds. Each failed trade raised stress levels further. Each rise in stress degraded the next decision. The pattern became self-reinforcing. There is one more psychological mechanism worth naming. Researchers call it the break-even effect. Once a trader is below their starting point, a powerful goal emerges, not to profit, just to return to zero. This sounds reasonable, but it changes risk tolerance completely. Position sizes grow. Stop losses get moved or removed. Risk management rules built over months get abandoned in minutes. The trader is no longer asking, is this a good trade? They are asking, will this get me back to even? That is a different question entirely. Three patterns show up repeatedly in the accounts of traders who have experienced revenge trading firsthand. A trader we will call Marcus followed a disciplined system for several months. He used fixed position sizing. He placed a stop loss on every trade. He tracked results in a spreadsheet. One afternoon, a news event caused a sharp move against his position. He hit his stop loss and exited. He was down $300 on the session. He opened another trade within 4 minutes. There was no setup. There was no analysis. There was only the loss he had just taken. That second trade failed. He doubled his position on a third attempt. By the end of the day, he had lost close to $2,000. The system he had followed for 7 months was abandoned in 4 hours. In his own words afterward, I knew what I was doing was wrong. I kept doing it anyway. This is the key detail. Revenge trading is rarely unconscious. Traders often recognize it in real time. The emotional drive overrides that awareness. Knowing is not enough to stop it. A trader we will call Dana had a different version of the same problem. Her revenge trades did not come immediately after a loss. They came about 20 minutes later. She had learned the rule, wait before trading again. She would step back, breathe, and return to the screen. She believed she had reset emotionally. The problem is that emotional states last longer than we perceive them to. 20 minutes after a significant loss, cortisol has not returned to baseline. The biological stress response is still active. It does not feel acute anymore. But it is still there. Donna was making decisions she genuinely believed were rational. Physiologically, she was still in the post-loss state. She described her discovery after tracking her trades for 3 months. Every trade she had opened believing it was a clear-headed recovery trade had lost money, without exception. The third pattern is the most predictable and the most costly. It occurs at the end of a losing week. A trader is down, Friday afternoon approaches, the session will close in a few hours, the week will end in the red. In that moment, many traders open a trade they would never consider on a Tuesday morning. The position is larger than normal, the setup is weak, not because the trade is good, because the week is almost over. This is deadline-driven revenge trading. The pressure of a time limit amplifies the emotional response. The trader is not evaluating the market. They are trying to avoid a psychological outcome, closing the week at a loss. The trade almost never works. The week ends worse than it would have if no trade had been taken. This one is personal. In 2012, the dollar-yen pair began a trend that few saw coming. Japan's central bank was changing course. The direction of the market was clear. I shorted it anyway. My reasoning felt rational at the time. The pair had already moved a long way. A pullback seemed inevitable. That kind of thinking has a name, value trading. It also has another name, fighting the trend. I was stopped out. I shorted again. Stopped out again. The pair kept climbing. At some point, the trade was no longer about analysis. It was about something else entirely. I had lost money on the short side, so I had to win it back on the short side. Any other direction felt like admitting the original loss was real. That is not logic. That is the break-even effect at full strength. The pair kept rising. I kept shorting. The losses compounded. By the time I stopped, the total damage was roughly $65,000. Every dollar of it lost in the same direction, against a trend that was obvious to almost everyone except me. The market was not the problem. I was. There are 3 tools that work against revenge trading. They do not work by changing how you feel. They work by changing what you are structurally allowed to do. Before you trade each session, set a maximum loss for the day. Write it down. A common starting point for retail traders is 1% of total capital per session. If your account holds $10,000, that limit is $100. When you hit that number, the session ends. No exceptions. Every professional trading desk in the world uses daily loss limits. They exist because professionals understand that losses affect judgment. A preset rule removes the need to make a judgment call under pressure. The decision has already been made. After every stop-loss exit, you do not trade for 30 minutes. This is not a suggestion. It is a structural rule. The reason is physiological. Cortisol needs time to clear. 30 minutes is a minimum. An hour is better. During that time, do not watch charts. Do not review the trade you just closed. Step away from the screen entirely. The pause does not recover the loss. It stops the loss from growing. Before every trade entry, write down 3 things. Why you are entering, where your stop loss is, what your target is. If you cannot answer all 3, do not enter. That is not a trade. That is a reaction. The log does 2 things. It slows down the decision process, which interrupts the emotional cycle, and it creates a record. After reviewing that log over 3 months, a pattern will emerge. The revenge trades will have no written rationale. Every time. Once you can see that pattern clearly, it becomes much harder to repeat. Revenge trading feels like taking action. It is not. It is the loss of control dressed up as effort. The traders who last are not the ones who never lose. They are the ones who stop after they lose. If this video helped, subscribe. Every week, we break down the psychology and the math behind how money is won and lost. Next week, the sunk cost trap. Why traders hold losing positions long after the rational exit point has passed. This is not financial advice. All case studies in this video are illustrative only.